Hey guys, what's up, how's it going? My name is Rob and welcome back once again for another video on today's channel. And inside today's video, I'm going to be giving you guys a full overview of my Canadian dividend-based growth portfolio here with Wealthsimple Trade, and I'll be showing you guys all the stocks I have inside my portfolio, giving you guys a rundown on how the portfolio works, and of course, I'll show you guys what stocks I'm actually going to be buying today towards the end of the video. So the first thing we're going to do here is I'm going to show you guys a quick little update on my portfolio and show you guys how it's been performing over the past year or 16 months or so it's been since we've started it. And before we go any further, I just want to say a big thanks to everybody who supports the channel, everybody who watches my videos. I'll bring up some referral income from Wealthsimple Trade. So for everybody who used my referral link in the past, I just want to say a big thanks because it really has helped me out personally as an investor to really grow this portfolio. If you look at our total portfolio, you can see how much it is. You know, $9,000 pretty much of that income was generated through referrals, as you guys can see here. So for everybody who supports the channel, it really makes a big difference. So thank you very much. And if you guys want to use my links, they are in the description of this video if you guys want to take advantage of Wealthsimple Trade's free offers. All right, so let's jump inside our portfolio and let's see how our stocks are doing this Friday morning. Alright guys, so quick little update before we go any further in the video is I'll give you guys a portfolio update so you guys can see how our return has been going, and then I'm going to dive into a couple of these stocks inside the portfolio, and I'm going to kind of focus more on some than others. I want to focus on some of the bigger ones, and then we can I'll mention some of the other ones here and there, and I will show you guys the holdings, but I will focus on a couple individual ones that I think are worth mentioning in this video that I think are really important for this portfolio. So first things first here, you guys can see we have $28,000, almost $29,000 inside of our TFSA. Over the past day, we are up $85, which is 0%. The stock market currently is not open today. It's 9 a.m., so it should open within the next half hour to hour. Over the past week, we are currently up about 251%, which is 1% in the past week. Over the past month, we're up $800, which is 3%. And then over the past 3 months, we're up $2,208, 8% in the past 3 months, which is pretty huge. Lots of growth to start this year in our Canadian stock portfolio. And over the past year, year to date, this portfolio is up 14%. So it's been steadily growing on a regular basis, as you guys have seen if you follow this channel. And that's about $3,462. So not too shabby at the end of the day. And then all time, we are up currently, once again, 13%, give or take. So that's a quick little update on the portfolio. Let's jump inside the holdings and let's talk about some of these stocks and go into some bigger detail and why I actually hold them inside my portfolio. Alright guys, so like I mentioned earlier, we'll focus on some of the more important ones inside the portfolio to get things started. But the first stock we're going to talk about is AQN, which is Algonquin Power and Utilities. And this is a utilities company that I think is one of the kind of more growth-based utilities companies, and I'm going to show you guys why, because they've just been doing really well over the past couple of years. I currently own about 46 shares inside my portfolio, and we're currently down just a tiny little bit for Algonquin Power and Utilities. But the main reason why I hold this company is because of the fact that they've had a huge growth in earnings and huge growth in stock appreciation over the past couple of years or so. This company has just been doing really well, and even though they've kind of hit a bit of a windfall over the past little while, I still think this stock is a great buy, and I think it's really priced at a really good price right now. And one thing I really want to focus on this company, even though they're like a really growing company, and you know they've obviously hit a lot of growth, and that will slow down over time. Let's take a peek at these earnings over the past couple of years for this company, because this is really important, I think, especially with everything going on right now. We can see in the past year or so, Algonquin Power's earnings have grown up 48%, which is huge. Now, obviously, the pandemic, you know, hit everybody, so everybody kind of jumped up quite a bit in the past year or so, or they should have, right? But you know, we can kind of see over the past 5 years, the annual earnings growth for Algonquin Power and Utilities is 54%, which is absolutely huge. And I always say, whenever a company is growing their earnings, they always have potential to like grow their stock, grow their dividend yield, and that's just a good thing. Companies should always be growing their earnings, and if a company can do that, they're probably going to do well, and it's worth investing into. So this is a big reason why I think this company is really solid right now. And a lot of these stocks I talk about today, we're going to look at some of the returns here, and I'm going to show you guys how not only dividend yield, but stock appreciation inside a good growth-based dividend stock, because that's going to be the focus of this video, is growth-based dividend stocks, stocks that kind of grow in stock appreciation, as well as those dividend yields over time. So let's take a quick peek at AQN. So over the past year, the stock is up 5.3%. So it's not too crazy, but remember guys, it's, you know, the beginning of the year, a lot of stuff happened last year, but over the past 3 years, this is a better representation. We can see that the growth of AQN just by stock appreciation is 67%. So I'll move this up so you guys can see, so my webcam's not covering it, but over the past 5 years, we can see an average increase of 93%. That's actually quite good for just stock appreciation for a dividend-based company, right? And because this is like a utility energy-based company, they're always going to have a good dividend yield. That's what Canadian stocks are known for. So if we hit this little checkbox here, which is really cool, we can actually see how much stock return is if you reinvest those dividends, right? So if you reinvested those dividends, all of a sudden that 1 year return goes up to 10%, which gives you a more accurate return of the stock. Over the past 3 years, that's a return of 92%. Once again, that's an extra 30% just from reinvesting those dividends. And here over the past 5 years, 142% return over 5 years is absolutely crazy. So I think this stock definitely, it's probably going to slow down over the next couple of years, right? But I still think going in the future is going to be a really good growth-based stock. And going further down in the portfolio, we can see some other stocks I have. See, these are some smaller individual shares that I do want to build up over time. But some we have here is ATD.B, which is Alimentation Couche-Tard. That's the Mac stores, all those special case stores that you guys see around Canada. They're pretty much everywhere. It's a really good growth-based company. Once again, it's a company that's growing their stock appreciation, but also aggressively growing their dividend yield. And that company, I think, in the future is going to be a really nice, good, solid dividend-based company. But going further down here, we have Brookfield Infrastructure Partners. This is an infrastructure-based company. Once again, a lot of the Brookfield stocks are just really good, solid stocks. And I bought this stock just for diversification and because they once again have had really good growth with really good dividend yield over time. You guys can see we're up 5% for this stock, and we currently own just 5 shares, but I'm looking to build that over time. The next big stock we're going to talk about is going to be CNR, or Canadian National Railway. This is a really, once again, really growth-based, dividend-based company. So let's take a peek at this company and let's see why I think this company is worth investing into. So for starters, Canadian National Railway is one of the most popular railway companies that we have here in Canada, and it's pretty well known. Like, if you guys don't know this company, you know, you probably not Canadian, right? So we can see here that the stock appreciation just over time, like over the past 20 years or so, has been absolutely crazy. This is a very fastly growing company, and they did really well during the pandemic. During the past year, they had tons of jump up, and it looks like they're just going to keep doing well. Their earnings have been pretty consistent. Now, once again, obviously the stock is pretty expensive at $146 Canadian, but I do believe it's still going to grow over time. And if we're looking at it from a dividend-based perspective, we can see that the dividend yield is currently 1.68%, which is actually pretty low for some people's standards. But let's take a quick peek on the dividend growth of this company to get an accurate picture of, you know, how that dividend yield can grow over time. So here's a quick little graph I want to talk about really quickly because it really goes to show the dividend growth rate of CNR stock over time. And this is one thing that a lot of people, dividend investors, don't think about, especially if you're like a younger investor. This is something that I didn't think about back in the day, is the concept of a growth-based company aggressively growing their dividend over time and how that really adds up and return. So we can see here CNR stock, you know, over the past couple, like 5 years or so, their dividend growth rate is sitting at 12.1% per year. So imagine getting a 12% growth from your dividend yield per year. It's absolutely crazy. So you guys can see that low dividend yield, even though it's low right now, those compounding returns over time will grow really quickly. So let's take a quick peek at that growth over time, and let's see how that dividend growth rate has really helped to get those earnings growing over the past couple years. Once again, we're back on Simple Wall Street. I'm doing a quick little update on the return over time. So over the past year, CNR stock is up 31%. As you guys can see, it's had a great run with the pandemic. Over the past 3 years, stock appreciation is up 55%, and over the past 5 years, 77% growth. So really good growth with stock appreciation. But when we turn on the dividend returns, we can see that dividend growth over time really starts to add up. And this is what really interests me about this company. So even though it's not a big dividend company right now, over time it will grow, and those dividends will really help to boost that return up. So over the past 3 years, this stock with dividends returns reinvested is up 63%. Once again, a lot of increase over the 55% we had earlier. And then over the past 5 years with dividends reinvested, that's 93%. That's almost 100% return over the past 5 years. So you guys can see that's pretty cool, not too shabby. So again, CNR stock I think is a really good stock, really good growth-based stock, and they're doing really well. Even though they're priced pretty high, I still think this is a stock worth buying. And the cool thing about the beginning of every single month is with this type of portfolio, not only are we getting stock appreciation over time, but we do get regular dividend payments. And this is really cool. And this is the thing that I like as an investor because it feels good to always be getting money, especially as that money grows over time. So let's take a quick little peek on some of the payments and some of the dividends we got because, you know, at the start of the month, we always get a bunch of dividend payments for some of these companies. So let's take a quick peek and let's take a quick peek and see some of the dividend payments that we got from our stocks that we hold. So like I mentioned, I think it's important to show the dividend payments over time and really how they've grown inside my stock portfolio here. So here's a quick little overview of some of the dividend income that I earned in April towards the end of March as well. So these kind of came up actually over yesterday in the past couple of days. So we can see we got a dividend from RioCan. RioCan is one of our REITs I'll go over in a bit here. We have Corp. Dividend of 0.84 cents. We have H&R REIT, another REIT, and you guys can see the REITs. The main purpose is once again just to kind of increase that dividend yield on a monthly basis. $7 from H&R REIT, and then we had VFE, which is an American stocks. I'll get towards this ETF towards the end of the video. This is $21, really good dividend, but of course, you know, it's quarterly based, so we get those big dividend chunks quarterly on a regular basis. And then we have Telus stock, which gave us a dividend of $2.80. So even though it's small little payments, they do add up at the end of the day, and we're taking that money, reinvesting it back inside the portfolio, and that's what's going to allow us to get that compound interest and just see our stocks really grow over time. Alright, so moving on with the portfolio, we have the next stock I want to talk about, and that is Ambridge. So Ambridge has been a really good stock, actually. I haven't invested in it too much because I do hold it in my main ETFs, but we do have 3 shares here. I will probably eventually just put this into an ETF and keep it in there, but they've actually done quite well, getting a gain of 13%. So obviously it's not that much money because I don't have much invested in Ambridge, but Ambridge is a great company. Instead, I kind of went with a different company called Fortis. Fortis is a more secure kind of, I think is going to be the longer term safer company when in regard to like a more consistent safe dividend yield. You know, Fortis has lower payout ratios, kind of more consistent growth, and I think over the long term this is just a better, safer play for me. Our Fortis stocks, we have 10 shares of Fortis. It's about 4.6% return right now. So this is once again going to be one of those longer term growth based companies that's more consistent. So that's why I like Fortis. Going down here we have H&R REIT, which is one of the first REITs inside our portfolio. REITs are starting to kind of rebound a bit, and I mainly added them because they got pushed down quite a bit from the pandemic. You know, REITs were down like 30-40% during the pandemic, and they're still sort of recovering, but they're not quite there. So big reason I invested into some of the REITs inside this portfolio is for diversification, for real estate, as well as to get that monthly income up, and because the stock price has been pushed down so much. You guys can see our H&R REIT return is sitting at about 8 to 9%, so not too shabby at the end of the day. Going down here we have Manulife. This is the next big company I'm going to focus on because I think Manulife is a really important stock, and as you guys can see, it's performed pretty well for me. Again, main focus I want to focus off with some of these stocks is really on growth and earnings over time. I think this is one of the most reliable metrics to kind of look at the company's history, see how they've done well, and if they're growing their earnings, growing as a company, then most likely the stock is going to grow over time. So once again, you can see with Manulife, this is a finance-based company. We can see here that over the past 5 years, the company has grown 18% per year, and even though the last year growth hasn't been that much, a lot of finance-based companies have kind of suffered over the past year, but Manulife actually did really well in the pandemic, and they're constantly expanding into different demographics. You know, they're expanding to the US, a lot of the Asian markets, and this is just a really good company. So Manulife, obviously, you know, really good growing company, and their dividends are always increasing. And we'll take a peek at the return, and let's see how Manulife has been basically doing over the past couple years. Alright, so this one's going to be really fun to do, and it's actually been one of my best performing stocks. So if we look at the return in Manulife here, let's go over the past year. We can see if the stock appreciation actually went up 51%. Now this is because this stock got hit really hard, like a lot of the finance-based stocks initially in the pandemic. It got hit really hard, and Manulife kind of had a slow recovery. You know, it's one of those stocks that slowly recovered, so I seen it as an opportunity to invest into. Still think it's a great stock to invest into, but over the past year, it's up 50% in stock appreciation alone, which is pretty crazy. Over the past 3 years, it's up 16%. So once again, you know, we factor in the pandemic, it kind of pushes it down a little bit, but we can see more accurately over the 5 years. We see a more accurate return of 46% in stock appreciation. Now, if we include dividends, once again, this is a stock that has a really good dividend yield, really good dividend growth, really good payout ratios, really just consistent stock, you know, that's going to grow over time. So over the past year, with dividend reinvested, that's a 60% gain. Over the past 3 years, 33%, which is pretty crazy. Once again, you can see the big difference in the dividends reinvested over just the stock appreciation. That's almost double. And then over the past 5 years, you can see once again, pretty much doubled with the 84% dividend yield. And this is because once again, when the stock appreciate, you know, the stock share prices got pushed really down, they kept their dividend yield up. So it's really important that you pick companies that have consistent dividends, you know, and when prices do go down, it's a great opportunity to buy a good dividend-based stock at a low price. So I think Manulife is absolutely amazing stock. And like I said, it's done really well inside my portfolio. We have 49 shares, up 22% almost, which is really solid. So of course my main goal for this portfolio is to create a sustainable, really easy to manage portfolio that basically works passively on its own by buying ETFs and whatnot as the main focus of the portfolio, and then we buy some individual stocks that always have almost a consistent history of basically growing in value over time, as well as increasing their dividend income. So that's the main focus of this portfolio, and that's why I kind of buy the stocks that I buy inside here. And of course the main goal one day is to live off our stocks and our dividend income completely, but in the meantime, you know, we can still take advantage of that stock appreciation and those dividends growing over time, because it, you know, at the end of the day, those things really do add up together to really increase the bulk of your return. Alright, and moving down with the portfolio, guys, we're kind of getting through this. I'm going to go over some of these other ones really quickly because, once again, they are solid stocks and we've seen some pretty good growth, but I don't want to focus on them too much because I've talked a lot of them on this channel. I just want to focus on some of my favorites here. So Ryokan, another REIT inside the portfolio. We have quite a bit of shares. I think Ryokan is one of the more consistent, safer REITs to buy just because it's a really good company. You know, they're doing what they need to do to kind of be consistent in the long term, and they've had nice little increases over time, and it is a nice monthly dividend stock. We have 11% gain with Ryokan over the past little while, which has been pretty solid for the portfolio. Next up we have is TransAlta Renewables. Renewable based companies have been doing really well. You know, we're up 20%. I don't have a ton of shares, but this is one I've been slowly buying over time. Next up we have is Corp. This is a healthcare based company. They make accessibility equipment and objects and items and stuff like that for the elderly and the disabled. This is once again a way for me to diversify the portfolio, and Corp has actually been a really big growth based company with a nice little monthly dividend yield, and we have a 17% return with them. Once again, this is just a company we're slowly buying a couple shares over time, looking to diversify the portfolio and take a little bit of risk by investing in some more growth based stocks. Going down here we have some of the telecommunications companies. I have two main ones inside my portfolio, which is Shaw and Telus. So Shaw is up 40%. You guys seen the news in regards to Rogers buying Shaw, so the stock price shot up, and pretty good return for a lot of people. We're going to hold these shares for now and just see how they do over time. Since I only have 11 shares, I don't think we might sell them at some point, but we'll just keep them for now. And then going down here we have Telus, which is more of a stable kind of growth based stock. Once again, it's more consistent, I think, in my opinion, and I'm not buying tons of shares of Telus because, once again, we do hold it in some ETFs, but I do think it is a good dividend based stock. So it's not doing too hot right now, but I think, you know, in the long term it is going to be one of those companies. And going down here we have some of the more important stuff I want to focus on today, and this is TD stock. So TD stock is going to be the last individual stock we're going to talk about, and I'm going to talk about it because it actually is my favorite stock at the end of the day. To Canadian banks, I think all the big Canadian banks are pretty solid stocks. I went with TD stock as my main one, but we do hold most of the big ones inside our ETFs. So once again, I think they're all really good companies. The banks are solid finance based companies. You can't really go wrong with banks. I think amongst everything going on right now with things opening and closing and the yada yada yada, I think if, you know, the banks are going to be solid, some of the best companies kind of deal with that kind of stuff. So TD stock over time has done really well. You guys can see the growth here. I got it pulled up here on Google Finance, and it's a huge company, $150 billion market cap, always growing over time. Dividend yield is 3.82%, so it's actually an established, good, solid dividend based company, and they are regularly increasing it on a regular basis. And this is just a really good stock that has had really amazing stock appreciation, really good growth, and it's been super consistent. So I think TD is, once again, I think it's one of the best, fastest growing banks. And like I said, I really like the fact that they're diversifying overseas and whatnot and into the US market, which I think is really important for stocks, especially established stocks, to just kind of take things to the next level. And once again, guys, I pulled out the 5-year dividend growth rate for TD stock from Guru Focus, and as you guys can see here, this stock has just been super solid at dividend increases. You know, and this is a company that has a super low payout ratio, tons of cash flows. So I think banks are some of the best companies for dividend growth rates because they just have the money to do so, and they're always performing at a low payout ratio. So TD is no different. You guys can see here 8.6% dividend growth rate per year over the past 5 years, which is really good. Once again, you can't really go wrong with these banks. They're just super solid, consistent stocks. And let's take a peek at the earnings just to show you guys how well TD has actually done over the past 5 years. So really quickly here, I want to mention, because TD got hit pretty hard from the pandemic, some of these shorter term returns will be a little bit lower, and you can see this here. So in the past year, the stock rebounded quite a bit from the pandemic. up currently about 43% with dividends reinvested. And over the past 3 years, it's actually only up 17 to 33%. Once again, that's because we're factoring in the pandemic. But over the past 5 years, which is a better accurate representation, we can see that 48 to 50% gain in stock appreciation. But here's the kicker, guys, 80% gain if you reinvested those dividends. So like I said, you know, these dividend-based companies that are growing their dividends, and TD already has a well-established dividend yield, just really solid return. And it just goes to show you that a lot of people think like growth stocks are some of the best stocks to get returns, and dividend stocks aren't really the greatest. If you guys pick the stocks that are kind of in the middle, you can get the best of both worlds. An 80% return over the past 5 years is a phenomenal return, guys. You can't really get much better than that with some of these more consistent stocks. So once again, TD stock, really solid company, really good returns over the long term. And of course, for any of you guys who are interested, I'll go over the monthly income sheet here in just a second, where you guys can see how much income we've made inside this portfolio since we started it way back here in January of 2020. So let's go over the sheet and let's see how our monthly income has grown over time. And before we get to the ETF section of the video, which is going to be the next section, let's go over the monthly dividend income, because it's important to talk about this. A lot of beginner investors need to see this. And I think this is so important for a lot of people, especially as we're going through times of uncertainty, or if you're ever just feeling like, you know, you've hit a plateau, or you just feel like what you're doing is not good enough. You can always reflect on a spreadsheet like this. You can see the growth over time, and you can feel good that what you're doing is getting you a positive result. So that's why I think these sheets are really important, and it just feels good to see that money grow over time. So here's the growth of the portfolio. As you guys can see here, we have the months on the left side, which is starting in January 2020, and then we have the dividends earned, which is total dividends earned for each month, and we are reinvesting those dividends back in the portfolio, so it's going to grow. And as you guys can see, these dividends are growing at a really fast rate. It didn't start off with very much, with a couple bucks, but you know, fast forward down here to where we are a year and a bit later, we're now approaching February and March, finished at almost $70. So really good gains. In April already is at $40 in dividends. So you can see that dividend growth really does matter, and it does grow really fast over time. And if you scroll down here a little bit more, we can see the total income return. So here's the total return for the dividends I just calculated this morning. That's $465, so we're almost at $500 in total dividends return for the portfolio. And I mentioned at the beginning of the video, I was going to show you guys what stock I was going to be buying today. So in today's video, we have $191, which is about $200. And I'm going to be buying TD stock. So once the market opens up, today's stock I'm going to be buying is TD. So I'm going to put that order through. Once again, it's my favorite bank stock. I just think it's a good company, and it's going to do really, really well. And before we end the video, I want to focus on two ETFs here. These are the main ETFs for the portfolio. We have VDY and VFV. So VDY is just our Canadian-based ETF to have more consistency across the market, just in case if our individual picks don't do well, even though they have performed quite well. And then we have VFV, which is the US market S&P 500. This is once again just for more consistency and to diversify into the US markets. This ETF has been absolutely just performing really, really well, as the S&P 500 does. And like I said, past 5 years up 93. That's almost 100%. In the past 5 years, that's an average of almost 20% return. Just really, really good ETF. And the cool thing about it is it's trading Canadian dollars, so you don't have to pay anything on currency conversion or anything like that. It's just a super simple way for Canadians to invest into US stocks. And I think every Canadian should hold at least some percentage of US stocks inside their portfolio, whether it be 20, 30%, 40%. I think you should have at least like 20, 30% minimum, and ideally a little bit higher than that. But I think US stocks are really important for a Canadian based portfolio. So I think VFV is a great fund. If you guys want to check it out, that's definitely one that's really accessible and really easy for everybody to buy in Wealthsimple Trade. And before we end this video, I want to show you guys a cool little tool you guys can use to calculate your dividend income return over the long term. So we're going to plug in some numbers really quickly. We're just going to use estimates, and this is going to be at the lower volume, just to kind of give you guys an example. This works. Feel free to punch in your own numbers. But here we have a market beat, which is a dividend calculator. I'm going to show you guys how your money can grow over time. So we're going to pick a portfolio here. This is going to be in a non-taxable account, just to keep things simple. The distribution will be quarterly, just to kind of keep things normal. We'll go no for drip once again, just to kind of keep things consistent. You can set it up the way you guys want. Our starting principle is going to be about how much money do we have inside our portfolio. We have about 28,623. So we'll punch that in really quickly. 28,623, and our annual contribution, I think more realistically, even though I have been putting about $1,000 to $2,000 a month into the market, I'm probably going to kind of taper that down realistically over the next couple of years to be about $1,000 a month. That's kind of my goal. So we'll go $1,000 times 12 is $12,000 per yearly contributions. Dividend tax rate, we'll put 0%, and just once again to get some raw numbers here. And dividend yield, or annual dividend yield, currently right now my portfolio is sitting about, I think it's 3.9 to 4%. So I'm just going to go 4% to make it simple. And then our annual dividend increase, this is where I talked about where companies are increasing their dividend yields over time. We're going to go about, I think most of our portfolio kind of sits around the 5 to 10% range. So I'm going to go like 7%, maybe something like that. And then expected annual share price appreciation. Once again, this is actually surprisingly high for us. But I think realistically we could expect like even anywhere between 5 to 10%. So once again, we'll go kind of in the middle, which is average about 7%. Let's calculate those returns. It probably ideally will be a little bit less over time. But once again, I just want to show you guys the compounding effect of this. So we can see every single year we have our starting principal here on the left side, we have our yield that's growing, we have our annual dividend, and then we have our principal increase. The principal increase is the stock appreciation, and the annual dividend yield is your actual dividend. So you can see the portfolio over time will fastly grow, and if we fast forward even just 5 years from now, that dividend yield is now getting us $4,000 a month, which is a yield of 5%, and our principal increase is $6,000. So that would be a total gain of about $11,000 to $12,000. Just from your stock portfolio. So that really starts to add up over time. And this is just if I stopped, and just put $1,000 a month right now. So you guys can see that the more you put in, obviously the more you grow, but things do grow over time. And you can just see the portfolio in 20 years to be $500,000, netting you $84,000 a year in dividends, 14% dividend yield with principal increase of $38,000. That's crazy. So I mean, over time, obviously the more you can invest, the faster you'll get there. But I just want to show you guys this cool little calculator that you can play around with to kind of see your return over time. Alright guys, that's it for this video. Let me know what you guys think in the comments. If you guys did enjoy this video, please sure to give it a big thumbs up, and remember to subscribe if you guys want to see more Canadian content. Other than that guys, I hope you guys enjoyed this video. Take care, have yourself a good weekend, and I'll see you guys later.